May 2012. JP Morgan's risk systems are screaming. Not the quiet warnings, the apocalyptic ones. A trading position worth billions is collapsing, and nobody's hitting the kill switch. Inside the bank's Midtown Tower, screens are flashing red. This position was supposed to be protected, safe, hedged against disaster. Instead, it's becoming one. The losses grow by the hour. 2 billion, then 4, then more. Within days, JP Morgan confesses, we lost $2 billion. Publicly, to regulators. The real damage is worse. $6 billion when the smoke clears. Biggest U.S. trading loss ever recorded. It all started with one desk in London. One trader. One bet the risk models somehow missed. Completely. Bruno Iksil didn't look like the problem. He was a French-Lebanese trader at JP Morgan's chief investment office, the London office specifically. The CIO sits on $350 billion. Roughly, that kind of money doesn't get trusted to just anyone in the market. Iksil had built a reputation for being careful, methodical, quiet. He wasn't a flashy investment banker type upstairs, chasing headlines. He was precise. He studied bond markets the way mathematicians study complex equations. By 2012, he owned the CIO's credit derivative strategy completely. Complex positions, instruments most traders wouldn't dare touch. His bosses didn't just trust him, they relied on him heavily. Iksil wasn't some cowboy chasing bonuses and glory. He was a technician, a problem solver working with billions in capital. He made the strategy work year after year. And here's how. Iksil wasn't buying stocks or bonds. He was engineering something far more abstract, a massive short bet on credit itself, betting that corporate debt would hold steady and prices would stay put. He placed these bets using derivatives called credit default swaps. Think of them like insurance contracts on bonds. He sold insurance, billions worth of corporate debt insurance. The position grew absolutely enormous. Billions in notional value. Massive, staggering scale. The leverage was incredible. Tiny market moves meant massive profits or catastrophic losses. JP Morgan saw the gains rolling in. They push him to grow it, build bigger, keep expanding. By 2011, his position was so large it wasn't just riding the market. His own trades were moving prices. The market was bending to him. But markets don't stay bent. In April 2012, volatility spiked hard. His massive short positions inverted overnight. Catastrophically, every trader on Earth could see the size, $100 billion notional exposure across credit indices. The entire market was watching him now. Suddenly, he was bleeding money on every single tick. Real money. Real losses streaming out everywhere. And here's the brutal trap. Selling meant crystallizing enormous losses to the entire world. Admitting complete failure publicly. But holding meant the bleed would never stop. The position had grown so large that exiting would move the entire market itself. He couldn't sell without destroying the price and admitting defeat. He couldn't hold without drowning. By mid-May, daily losses hit $200 million. Every single day, another $200 million gone. The hedge had become the catastrophe. The trap had closed. By late April, Diamond's team understood they had to exit. Selling slowly meant death by 1,000 cuts. Selling fast meant triggering the panic that would crater everything. Either way, the market was already hunting them. Other traders at rival banks had spotted the massive bet months ago. Some had positions specifically to profit when JP Morgan unwound. This wasn't coincidence. It was calculated. As JP Morgan moved assets, prices moved against them with eerie precision. By bids vanished. Exit costs tripled in days. By mid-May, losses crossed $3 billion. Then 4. Traders described it like drowning. The harder you thrash, the faster you sink. JP Morgan owned most of a market that had turned fully hostile. There was no gradual way out. Every attempt to sell cost another billion. Diamond's famous quote came early. "A tempest in a teapot," he said. The market begged to differ entirely. By September 2012, JP Morgan had swallowed the full $6.2 billion loss. Shareholders weren't amused. The Securities and Exchange Commission launched an investigation. The comptroller of the currency piled on immediately. The bank paid $920 million in combined fines, one of the largest financial settlements ever recorded. But the real damage was systemic. Risk models had catastrophically failed. The very systems designed to prevent this had completely missed it. JP Morgan held $300 trillion in derivatives on its books. If they could lose $6 billion, what else was missed? The London whale became the textbook case. Banks rewrote their risk protocols overnight. Regulators tightened stress tests. One trader's $6 billion mistake rewired global finance forever.